Welcome to the deep dive. All right, let's get right into it. Have you ever, stared at a company's balance sheet, specifically that stockholders' equity section, and just felt lost?
Yeah.
Like you need some kind of secret decoder ring.
Oh, absolutely. It happens all the time. You see these big numbers.
Yeah, and you wonder, okay, what do these really tell me about the company's health or, its relationship with the owners?
Exactly. Well, today we're going to try and crack that code. We're diving deep into, well, the whole world of owner's claims, company capital, and how all those numbers really do paint a critical picture of a business.
Awesome, so get ready, because we're taking that deep dive today.
Yeah, and what's really cool here, I think, is that stockholders' equity isn't just some static number you look at once. It's dynamic. It's like a living reflection of the company's whole financial journey.
Okay. Like,
Well, it shows how they first got funding, raised capital, how well they've managed their profits over time. Did they keep them or pay them out? And even how they deal with their own shares, like buying them back.
yeah.
Understanding all that is, well, it's fundamental.
So without grasping equity, you're kind of missing a huge piece of the puzzle regarding the company's actual financial health.
You absolutely are. It's the bedrock, really, how the company stands financially in relation to its owners.
Okay. So our mission today, then, is pretty clear. We want to pull back the curtain, demystify this whole stockholders' equity thing for you, our listeners. We'll break down the main parts, show how things change with different transactions, and maybe most importantly, explain why knowing this stuff is crucial for anyone interested in business or finance.
Yeah.
We want those aha moments for you.
Definitely aiming for clarity, turning that financial jargon into something, useful, actionable insights.
Perfect. Let's start right at the beginning then. The absolute bedrock.
Mm.
What is stockholders' equity?
Okay, so at its core, you might also hear it called shareholders' equity or owner's equity. Same thing. It simply represents the owner's claim on the net assets of the corporation.
Net assets. Okay, break that down. What does net mean here?
Good question. Net assets just means you take everything the company owns its assets and subtract everything it owes its liabilities. What's left over? That's the net assets. It's the residual value, essentially. The part that truly belongs to the owners after all the debts are theoretically paid off.
Got it. So assets minus liabilities equals equity, the owner's slice.
Exactly. And that's a crucial point. If you picture a balance sheet or, the statement of financial position equity is usually the last big section, right after liabilities. And it's really important how it's presented. The different pieces inside equity need to be clearly classified.
Why is that so important? Just an accounting rule.
Well, it's more than just a rule. It's about transparency. It shows where the capital came from. Did the owners put it in directly? Was it earned through running the business and kept? Or did it come from other less common sources? That classification tells a story about how the company built itself up and generated value.
I like the story idea. Okay, maybe an analogy would help. You mentioned a pie earlier.
Yeah, the pie analogy works well here. Think of the whole pie as all the company's assets, everything it owns.
Okay, big pie.
Big pie, hopefully. Now, a slice gets taken out for liabilities. That's what the company owes to others, banks, suppliers, maybe bondholders.
Right, the debts.
Exactly. So what's left of the pie after you take out that liability slice, that remaining portion is the stockholders' equity. It's the owner's piece, their claim.
Okay, that clicks.
Mm.
Assets minus liabilities equals the owner's part of the pie. Simple enough. Now let's make it real. You mentioned looking at an example, Capital Core. What does their equity section look like?
Right. So looking at the Capital Core, consolidated shareholders' equity for December 31st, year one, we see these main categories laid out. There's capital stock listed at $350,000.
Okay.
Then additional paid-in capital at $209,000.
Got it.
Retained earnings showing $370,000.
A big chunk.
A very significant piece, yes. Then a smaller amount, accumulated other comprehensive income at $10,000.
Okay.
Then there's a subtraction. It says less. Cost of shares in treasury, and that's $85,000.
We'll need to unpack that one later.
Definitely. And finally, there's an addition for non-controlling interest of $25,000.
Another one to circle back on. So what's the grand total?
Add and subtract all those, and the total equity comes out to $879,000.
Okay, here's where it gets really interesting. Looking at Capital Core, you can see these big categories. Let's break down each one and understand what they represent, moving beyond just the numbers, starting with capital stock.
Absolutely. Capital stock is often the first thing listed. Legally, it's often tied to the concept of legal capital.
Legal capital, what does that mean?
It's basically the minimum amount of capital that a corporation is required by law to keep within the company. It acts as a kind of safety net. primarily for the protection of the company's creditors.
Ah, okay. A buffer.
Exactly, a buffer. And this legal capital is usually represented by the par value, or sometimes a stated value, of both the preferred and common stock that's been issued. It's a regulatory baseline.
You mentioned par value. I've seen that on stock certificates, like $1 par value or even less. But the stock trades for way more. What is par value then? It doesn't seem related to the market price at all.
You're spot on. That's a super common point of confusion. Par value is just a nominal value assigned to each share in the company's charter. It's often incredibly low, like you said, maybe $1 or even a penny. It has almost zero connection to the actual market price or the real value of the stock. It's more of a historical legal artifact.
Okay, so just a formality.
Largely, yes. Most preferred stock has a par value. Common stock might have a par value, or it might be no par stock. If it's no par, sometimes it's assigned a stated value, which basically functions the same way as par value for calculating that legal capital.
So if a company sells stock for, say, $20 a share, but the par value is only $1, what happens to the other $19?
Great question. That's where the next line item often comes in. That excess amount received, the $19 in your example, goes into additional paid-in capital, or APIC. So the accounting clearly splits the nominal par value from the actual cash premium the company received above that value.
Okay, that makes sense. Separating the legal minimum from the extra cash infusion.
Yeah.
Now, speaking of shares, we hear different terms thrown around. Authorized, issued, outstanding. Can you clear those up? They sound important for understanding ownership.
They are incredibly important. Yeah, let's break them down. Authorized shares, that's the absolute maximum number of shares the company is legally allowed to issue according to its corporate charter. Think of it as the ceiling.
The potential supply.
Exactly. Now, issued shares are the shares from that authorized pool that the company has actually sold or distributed to someone at some point.
Okay, so they've left the company's hands.
Right. But here's the nuance. Sometimes a company buys back its own issued shares from the market. These repurchased shares are called treasury stock. So, outstanding shares are the issued shares that are currently held by investors, meaning everyone except the company itself. It's issued shares minus any treasury stock.
Ah, okay. So issued includes treasury stock, but outstanding excludes it.
Precisely. And connecting this to the bigger picture, these distinctions are vital. Why? Because treasury stock, even though it was technically issued, is not outstanding.
Yeah.
And crucially, treasury stock doesn't get voting rights and doesn't receive dividends.
Wow, okay. That's a subtle but really important detail for investors calculating their voting power or dividend income.
Absolutely. It affects control, it affects payouts. That's why companies must disclose the number of shares in each category authorized, issued, and outstanding. Transparency is key.
Got it. So let's talk about common stock now. That's a main type most people think of, right? The basic ownership.
Yes, common stock represents the fundamental residual ownership interest in a corporation. Common shareholders are the true owners in that sense.
Residual meaning they get what's left over.
Exactly. They bear the ultimate risk. If the company goes bust, they're last in line to get anything back after all the creditors and any preferred shareholders are paid.
Ouch.
Yeah, but the flip side is they also get the ultimate benefits of success. If the company does really well, their potential upside is theoretically unlimited. But, and this is important, they are not guaranteed dividends. The board decides if and when to pay them. And they're not guaranteed specific assets if the company dissolves.
So high risk, potentially high reward. What are their main rights then, besides that potential reward? Voting.
Voting is a big one, yes.
Right.
Common shareholders generally have the right to vote on major corporate matters, like electing the board of directors. That's how they exercise control over management. They also have the right to share in the company's earnings if dividends are declared. And as we said, the right to share in assets upon liquidation after everyone else is paid.
What about preemptive rights? I've heard that term.
Ah, yes. Preemptive rights are an optional right. It's not automatic. If it's granted in the company's articles of incorporation, it gives existing common shareholders the first shot at buying new shares the company issues. The idea is to let them maintain their proportionate ownership percentage so they don't get diluted when the company sells more stock.
That seems pretty valuable for existing owners. Keeps their slice of the pie the same size relative to others.
It can be, definitely.
Now, how do we measure the value of common stock per share from the accounting books? Not the market price, but the book value.
Right. Book value per common share. It's a theoretical accounting number. It represents the amount each common share would hypothetically receive if the company liquidated all its assets at their recorded book values and paid off all its liabilities and preferred stockholders.
So based on the balance sheet numbers, not what things are actually worth today.
Exactly. It's calculated pretty simply. Take the total common shareholders' equity and divide it by the number of common shares currently outstanding.
Okay, but how do you figure out the common shareholders' equity part? Isn't total equity for everyone?
Good point. You need to isolate the common shareholders piece. So you start with total shareholders' equity. Then you subtract the value of any preferred stock outstanding, and you use the higher of its call price or its par value for this calculation. You also need to subtract any cumulative preferred dividends that haven't been paid yet. Those dividends in arrears we'll talk about more later.
Ah, okay. So you strip out everything that belongs to preferred holders first.
Precisely. What's left is the portion attributable solely to the common shareholders based on the accounting records. It's a useful metric, but yeah, usually quite different from the market price, which is all about future expectations.
Got it. Now let's switch gears to that preferred stock you mentioned. It always feels a bit like a hybrid, part stock, part something else. What's its deal?
You nailed it. It really does act like a hybrid security. It is equity, it represents ownership, but it comes with special preferences over common stock.
Preferences like?
Usually regarding dividends and or how assets are distributed if the company liquidates. They typically get paid before common shareholders in both scenarios, but the trade-off is that preferred stock usually doesn't come with voting rights. So preferred shareholders typically don't get a say in running the company.
Okay, so they get priority for payouts, but less control. Let's dig into those dividend preferences. I've heard of cumulative preferred stock. What does that mean?
Cumulative is a really important feature for preferred investors. It means if the company skips paying a preferred dividend in any given year, that missed dividend doesn't just disappear, it accumulates. These unpaid accumulated dividends are called dividends in arrears, and the key rule is the company must pay all those arrears in full before it can pay any dividends to common shareholders.
Wow, okay, so it's a strong protection for preferred holders. Are those arrears listed as a liability on the balance sheet?
No, technically they aren't a formal liability because the dividend hasn't been declared yet. But their existence is super significant information for investors, so it must be disclosed. Usually you'll see it mentioned right on the balance sheet in parentheses or detailed in the footnotes.
And the alternative is non-cumulative.
Right. With non-cumulative preferred stock, if a dividend is skipped, it's just lost forever. It doesn't accumulate, so much less protection there.
Okay. Now, what about participating preferred stock? That sounds counterintuitive. If it's preferred, how does it participate with common stock?
Yeah, it's a fascinating feature. Participating preferred stock allows the preferred shareholders to receive more than just their standard fixed dividend. They get to participate or share with common shareholders in any dividends paid out above a certain level.
Huh. How does that work?
Well, first, the preferred shareholders get their basic preference dividend. Then, usually the common shareholders get a dividend up to a similar rate based on their par value. After that, if there's still more dividend money to distribute, it's shared between the preferred and common shareholders based on a specific formula, often tied to their total par values.
Can participation be limited, or do they share indefinitely?
It can be either full participation, meaning they share in all excess dividends without limit, or partial, where their extra share is capped at a certain percentage or amount.
This sounds like it could get complicated in practice. Can we walk through that Samuel Co. example? Seeing in the numbers might help make it clearer how the cash actually gets divvied up.
Definitely. An example is the best way to see this play out. So Samuel Co. has two types of stock, 100,000 shares of $5 par common stock and 25,000 shares of $10 par, 8%, cumulative and fully participating preferred stock.
Okay, cumulative and participating. Got it. And they skip dividends in year one, but paid $101,000 in year two.
Correct. So year one, nothing paid. Year two, they declare $101,000 in cash dividends. Where does that money go first?
Well, it's cumulative preferred, and they missed year one. So the year one preferred dividends have to be paid first, right? The arrears.
Exactly. First step, pay the dividends in arrears. The annual preferred dividend is 8% of the total preferred par value. Total preferred par is 25,000 shares. 10 share equals $250,000. So the annual dividend is 8% of $250,000, which is $20,000. Since they missed year one, that $20,000 is in arrears. So from the $101,000, the first $20,000 goes to pay those arrears.
Okay, $20,000 down. That leaves $81,000. What's next?
Next is the current year's year two. preferred dividend. They're entitled to another $20,000 for year two, so we subtract that $20,000 as well.
All right, another 20K out. Now we're down to $61,000 remaining from the original $101,000.
Correct. $40,000 has gone to preferred shareholders so far, 20K arrears plus 20K current. Now, because it's participating preferred stock, the common shareholders typically get a matching dividend rate before any further sharing happens. Common stock has a total par value of 100,000 shares. 5 shares, we flip $500,000. The preferred rate was 8%, so common shareholders get 8% of their $500,000 par value. It was $40,000.
Okay, so $40,000 from the remaining $61,000 goes to the common shareholders now.
Yes. Subtract that $40,000, and that leaves us with $21,000, $61,000, $40,000.
Okay, this $21,000 is the amount they participate in.
Yeah.
How is it split?
Precisely. This final $21,000 is split pro rata based on the total par values of both classes of stock. Preferred total par value is $250,000. Common total par value is $500,000. The combined total par value is $750,000.
Okay.
So preferred gets their share, $250,000, $750,000, $21,000, and $7,000. And common gets their share, $500,000, $750,000, $21,000, $14,000.
Got it. So let's tally up the final amounts for each group in year two.
Okay. Preferred shareholders get $20,000 year one arrears, plus $20,000 year two current, plus $7,000 participation amount. Total equals $47,000. Common shareholders get $40,000 matching dividend, plus $14,000 participation amount. Total equals $54,000.
And does that add up? $47,000 plus $54,000. Yes.
Mm-hmm.
$101,000. Perfect. Wow. This example really brings to life how these preferences play out. It's not just theory, it's how the cash actually flows to shareholders based on these specific features.
It really does. It shows the sequence and the rules very clearly.
And just to be clear, if the preferred stock was non-participating, they would have just gotten their $20,000 arrears and $20,000 current dividend, and the rest, $61,000, would have all gone to common.
Generally, yes. Non-participating preferred are limited to just their stated preference dividend, no sharing in the extra profits distributed.
Okay. And you mentioned a liquidation preference, too.
Right. Similar to dividend preference, preferred stock might also have a preference in liquidation, meaning they get paid back their investment, usually par value plus any unpaid cumulative dividends, before common shareholders get anything if the company dissolves. If this liquidation preference is significantly higher than the par value, that fact needs to be disclosed prominently right in the equity section, not just hidden in footnotes.
Makes sense. What about those other features? Convertible, callable, mandatorily redeemable. Quick rundown.
Sure. Convertible preferred stock gives the shareholder the option to exchange their preferred shares for a set number of common shares. Offers potential upside. Callable or redeemable preferred stock gives the company the option to buy back the preferred stock at a specified price, the call price. Gives the company flexibility.
Okay. Shareholder option versus company option. What about mandatorily redeemable? That sounds different.
It is very different. Mandatorily redeemable preferred stock has a fixed maturity date, meaning the company must buy it back on that date. Because of this mandatory repayment obligation, it's actually classified as a liability on the balance sheet, not equity. It acts much more like debt.
Whoa. So even though it's called preferred stock, it's treated as debt for accounting.
Unless the redemption is only required upon liquidation, yes. It highlights how the economic substance, that unavoidable obligation to pay back, overrides the legal form or name.
That brings up a good point. Why would a company issue all these different complex types of preferred stock? Seems like a hassle.
It's a great question. It really boils down to strategic financing. Each feature appeals to different investor types or serves a specific company need. Convertibility might attract growth investors. Callability gives the company refinancing flexibility if rates fall. Issuing preferred might be less dilutive to common shareholders' control than issuing more common stock. Mandatorily redeemable might be used in specific financing structures. It's all about tailoring the capital structure, balancing cost, risk, flexibility, and investor appeal.
Okay, that makes sense. It's about having different tools in the financial toolkit. Let's move on to how equity changes more broadly. We talked about additional paid-in capital, AP, briefly. It's the amount over par value from stock sales, but you said it has other sources too.
Yes, APIC is more than just the initial premium over par. Think of it as a category for various capital contributions that aren't par value or retained earnings. For example, if a company resells treasury stock for more than it paid, that gain goes into APIC, not income.
Why not income? Isn't it a gain?
Because it's considered a transaction with owners or potential owners, a capital transaction, not part of the company's main operating business. So equity adjustment, not income, other sources. Liquidating dividends reduce APIC. Proceeds from converting bonds into stock can impact it. Small stock dividends use APIC. Money kept from defaulted stock subscriptions can end up there. Even donations of stock or assets can increase APIC.
So it's kind of a catch-all for capital contributions beyond par and earnings.
That's a good way to put it. And it's usually just presented as one single aggregated number on the balance sheet.
Okay. Next big one. Retained earnings. This feels like the heart of the company's accumulated success, right?
It absolutely is. Retained earnings represents the total accumulated net income or loss, called a deficit if negative, the company has earned over its entire existence, minus all the dividends it has ever paid out to shareholders.
So it's the profits kept in the business.
Exactly. Profits reinvested back into the company, used to pay down debt, or held for future opportunities. It shows how much value generated through operations has been retained versus distributed.
And how does this number change from one year to the next? Is there a standard calculation?
Yes, there's a very clear flow. You start with the beginning retained earnings balance. You add the net income for the period, or subtract net loss. You subtract any dividends declared during the period, cash, property, stock. Then you make adjustments for certain rare items like prior period adjustments to fix past errors or some retrospectively applied accounting changes. And that gives you the ending retained earnings balance. It's constantly moving based on profitability and distribution decisions.
I've also seen appropriated retained earnings. Does that mean they've actually set aside cash somewhere, like in a separate savings account for a specific project?
That's a common misconception, but no. Appropriating retained earnings does not involve physically setting aside cash. It's purely an internal accounting classification. It's basically the company signaling to shareholders, hey, this portion of our retained earnings isn't available for dividends right now.
Why would they do that?
Could be for several reasons, maybe legal requirements, some states require reserves, maybe contractual obligations, a loan agreement might restrict dividends, or it could just be the board's decision earmarking funds internally for a future expansion, potential lawsuits, or other contingencies. The key is it just relabels a part of retained earnings. The journal entry is simple. Debit retained earnings, unappropriated. Credit retained earnings, appropriated for purpose. No cash moves, it's just communication within the equity section.
Okay, so it's a signal, not a separate bank account. Good clarification. Now, what about accumulated other comprehensive income, AOCI? This one always seems a bit mysterious. It affects equity but isn't part of net income.
Yeah, AOCI is fascinating. It captures specific types of gains and losses that, according to accounting rules, bypass the income statement but still impact the company's overall equity.
Like what kind of things?
Common examples include certain adjustments related to pension plans, unrealized gains or losses on specific types of investments, available for sale debt securities, fluctuations from certain hedging activities, and adjustments from translating foreign subsidiary financial statements into the reporting currency.
So real economic changes, but they don't hit the bottom line net income number right away.
Exactly. Think of AOCI as a holding tank in the equity section. These items are recognized in comprehensive income, which includes net income plus these other comprehensive income items, giving a fuller picture of economic performance. But they don't flow into retained earnings until they are realized in some specific way, if ever. So AOCI is shown as a separate component of equity, distinct from contributed capital and retained earnings.
A holding tank. I like that. It captures value changes not yet reflected in traditional profit. Okay, let's tackle treasury stock. This is when a company buys back its own stock, right?
Correct. Treasury stock is a company's own stock that it previously issued but has since repurchased from the open market or directly from shareholders and is now holding itself. Crucially, it hasn't been formally retired or canceled.
Why do companies do this?
Many reasons. To return cash to shareholders indirectly, to increase earnings per share by reducing the number of shares, to have shares available for employee stock option plans, or sometimes just because management thinks the stock is undervalued.
And what rights do these treasury shares have? Can the company vote them? Do they get dividends?
No rights at all. Treasury shares are considered issued but not outstanding, so they don't have voting rights and they don't receive dividends. The company essentially reduces its voting base and its dividend payout obligation.
Does buying treasury stock affect retained earnings in any other way?
Yes, often it does. Many jurisdictions require that retained earnings be restricted by an amount equal to the cost of the treasury stock held. This means that portion of retained earnings cannot be used to pay dividends. It prevents a company from paying out capital through dividends while simultaneously using capital to buy back shares.
Okay, restriction on retained earnings. Now, accounting methods you mentioned too. Cost method and legal par value method. Cost method is the most common.
Overwhelmingly so. Probably 95% or more of companies use the cost method. The legal or par value method is quite rare.
What's the main difference between them?
The key difference is how and when they recognize any gain or loss when the treasury stock is eventually reissued or sold. But, and this is super important, any gain or loss on treasury stock transactions never hits the income statement under either method. It's always treated as a direct adjustment to stockholders' equity. It's a capital transaction.
Never income. Got it. Capital transaction. And under both methods, treasury stock isn't counted as outstanding.
Correct. Not outstanding under either method.
Okay, let's unpack the cost method since it's so common. How does it work when they buy the shares back?
Simple enough. Under the cost method, treasury stock is recorded at whatever the company paid to buy it back its reacquisition cost. The journal entry is debit treasury stock for the total cost, credit cash.
Straightforward. What about when they reissue it? Say they sell it for more than they paid.
If they reissue it above cost, you debit cash for the proceeds, you credit treasury stock for its original cost, and the difference, the gain, is credited to an equity account, usually called additional paid-in capital treasury stock, or APIC-TS.
So the gain increases equity but not net income. What if they sell it for less than they paid? A loss.
If they reissue below cost, you still debit cash for the proceeds and credit treasury stock for its original cost. The loss is handled in a specific order. First, you reduce debit any existing positive balance in that APIC treasury stock account from prior gains on treasury stock transactions.
Okay, use up previous gains first.
Right. If that APIC-TS account balance isn't enough to cover the entire loss, or if it's zero, then the remaining amount of the loss is debited directly to retained earnings.
Ah, so a loss on treasury stock can reduce retained earnings, but a gain never increases it.
Exactly. Gains go to APIC-TS, losses use up APIC-TS first, then hit retained earnings. Net income is never increased by these transactions. It really underscores that these are capital adjustments, not operating results.
Okay, that makes sense. So it's definitely counterintuitive if you're just thinking gain and loss normally. What about the rare legal par value method? How does that work differently?
The par value method is more complex conceptually. It tries to reverse the original accounting entry when the stock was first issued. When shares are reacquired, you open debit treasury stock, but only for its par value. You also debit additional paid-in capital common stock for the pro rata share of the original premium received when those specific shares were issued. If the repurchase price is more than the original issuance price, the excess difference is typically debited to retained earnings after reducing any APIC-TS. If the repurchase price is less, the difference is credited to APIC treasury stock. It's much more about undoing the original capital accounts rather than just holding the shares at cost.
Wow, okay. That sounds significantly different in the details. But you said earlier that total stockholders' equity ends up being the same under both methods.
Yeah. Yes, that's the crucial outcome. While the individual line items within the equity section look different, the bottom line total stockholders' equity is identical. Under the cost method, treasury stock appears as a deduction, a contra-equity account, at its cost. Under the par value method, the common stock and APIC accounts are directly reduced. The net impact on the total is precisely the same. It's really a presentation difference.
Okay. Presentation difference, same total equity. What if a company buys back shares not to reissue, but to actually retire them permanently?
If the intent is retirement, the accounting treats it as a formal reduction of capital. The common stock account is reduced by the par value of the retired shares. If the price paid to retire the shares was more than the original issuance price, par plus original APIC, that excess cost is usually charged against APIC from the same class of stock first, and then against retained earnings. If the retirement price was less than the original issuance price, the difference is generally credited to APIC. It formally shrinks the company's capital base.
Got it. One last quirky one. Donated stock. A shareholder just gives shares back to the company for free.
It happens sometimes. Maybe a major shareholder wants to help the company's financial position or increase the value for remaining holders. When stock is donated, total shareholders' equity doesn't actually change at the moment of donation. But the number of outstanding shares decreases.
Ah, so the pie stays the same size, but there are fewer slices, making each remaining slice bigger. Increases book value per share.
Exactly. That's the main effect. The company records the donated stock as treasury stock at its fair market value on the date of donation, with the credit going to additional paid-in capital. If it's later sold, APIC is adjusted accordingly. It's like getting capital back without paying for it.
Okay, we've got the building blocks and the dynamic internal changes down. Let's pivot now to the more active stuff. Actually issuing stock, paying dividends, and reporting all these changes. Starting with issuing stock. How's that recorded?
When a company issues stock to raise capital, the accounting depends on the par value, as we discussed. By far, the most common case is issuing above par. Cash comes in, debit cash. Capital stock is credited for the par value amount, and the excess cash received over par value is credited to additional paid-in capital, API.
Simple enough. What if, hypothetically, it was issued exactly at par?
Even simpler, debit cash, credit capital stock for the same amount, no APIC involved.
And issuing below par. You said that's rare and problematic.
Extremely rare, legally complex. If it happened, cash would be debited, but APIC would actually be debited for the discount amount, and capital stock credited for par. That discount essentially represents a potential liability for the original shareholders. Companies avoid this.
Gotcha. What about stock subscriptions? Like a layaway plan for stock?
Good analogy. It's a contract to sell shares, but the buyer pays over time, often in installments. The shares aren't issued until fully paid. Initially, the company records a receivable. Debit subscriptions receivable for the total price. Credit capital stock subscribed, a temporary equity account for the par value. Credit APAC for the premium.
So the equity goes up right away, even though the cash isn't all in yet.
Sort of, but the subscriptions receivable is usually shown as a deduction from equity, a contra-equity account, until it's collected. So the net impact reflects only the cash received, as cash comes in. Debit cash, credit subscriptions receivable, when fully paid. Debit capital stock subscribed, credit the actual common stock account, the shares are now formally issued.
What if someone defaults and doesn't finish paying?
Depends on the contract and state law. The company might issue fewer shares based on what was paid, refund the partial payment, or sometimes keep the amount paid as forfeited, crediting it to APIC.
Okay. And stock rights.
Okay.
Giving existing shareholders a chance to buy more shares, usually cheaper.
Right. It's a way to raise capital while letting existing owners maintain their stake. Issuing the rights themselves is just a memo entry, no financial impact yet. When the rights are exercised and shareholders pay to get the new shares, then it's recorded like a normal issuance. Debit cash, credit common stock, par, credit APIC for the excess.
What if stock is issued for something besides cash? Like paying lawyers with stock or selling stock together with bonds in one package?
If stock is issued for services, you record the transaction at the fair value of the stock given up. That's usually the most reliable measure. If you do a basket sale, stock and bonds sold together for one price, you have to allocate that total price between the stock and the bonds based on their individual relative fair market values. Can't just lump it all together.
Okay, that covers issuance. Now, distributions back to shareholders. Dividends are the main way, right? What are the key dates we need to know?
Yes, dividends are the classic distribution. 3 key dates. 1, date of declaration. This is when the board of directors officially approves the dividend. This is when the liability is created. Entry. Debit retained earnings, credit dividends payable. 2, date of record, the cutoff date. Whoever owns the stock on this date gets the dividend. No journal entry needed here, just determines who gets paid. 3, date of payment, the day the cash or other asset is actually distributed. Entry, dividends payable to remove the liability, credit cash.
Declaration, record, payment, got it. And types of dividends, beyond just cash.
Oh yeah, several types. Cash dividends, most common. Paid from retained earnings, only paid on outstanding shares, so not on treasury stock.
Yeah.
Property dividends, distributing assets other than cash, maybe inventory, equipment, or shares of another company it owns.
How do you account for giving away, say, equipment?
First, you have to adjust the asset being distributed to its fair market value right before distribution. Any gain or loss on that adjustment hits the income statement. Then you record the dividend liability, debit retained earnings, credit dividend payable at that fair market value.
Interesting. Okay, what else?
Strip dividends, basically an IOU. The company wants to pay a dividend but is short on cash. They issue a note payable promising to pay later. Debit retained earnings, credit notes payable, often carries interest. Liquidating dividends. This is a big one. It means the dividend exceeds the balance in retained earnings. The company is returning contributed capital, not just distributing profits.
So it reduces more than just retained earnings.
Yes. It first reduces APAS, and if that's not enough, it even reduces the capital stock accounts. It's a return of capital, shrinking the company's equity base.
That definitely signals something different than a regular profit distribution. What about stock dividends? Getting more shares instead of cash.
Right. Stock dividends distribute additional shares of the company's own stock. The key here is the accounting differs based on the size of the dividend.
Size matters. Okay, what's a small stock dividend?
Generally, less than 20–25% of the shares already outstanding. The market isn't expected to react much to the price per share. For accounting, you transfer the fair market value of the dividend shares from retained earnings into the permanent capital accounts, capital stock at par, and APIC for the excess.
So if 5,000 shares are issued as a small stock dividend, par is $10, market value is $15.
You debit retained earnings for the market value, $5,000, 15 will $75,000. You'd credit common stock for par, $5,000, 10 equals $50,000. And credit APIC for the difference, $25,000.
So what does this all mean? A small stock dividend is like rearranging furniture within the equity section. The total size of the room doesn't change. Total equity is the same, just shifted from RE to contributed capital.
Perfect analogy, exactly right. No change in total equity, just capitalizing earnings.
Okay, then what's a large stock dividend?
More than 20–25%. Correct. And because it's so large, it is expected to materially reduce the market price per share, similar to a stock split. Because of that expected market impact, the accounting is different. You only transfer the par value or stated value of the dividend shares from retained earnings to capital stock.
Just the par value, not market value.
It's par. So if it was a 40% dividend on 1M shares with $10 par, 400K new shares, you'd debit retained earnings and credit common stock or common stock distributable initially for just $400,000. 10 equals $4 million. No APIC involved here typically.
So a large one is more like getting a new floor plan, significantly impacting the number of shares and using only par value for the accounting. Do stock dividends get paid on treasury stock?
Generally, no, since treasury stock isn't outstanding. Exceptions are rare, maybe to maintain ratios for stock options or if state law requires it.
Okay. How does a stock split differ from a large stock dividend? They both increase the share count and lower the price, right?
They have a similar economic effect, but the accounting and mechanics are different. A stock split involves issuing more shares, like 2 for 1, 3 for 1, but also proportionately reducing the par value per share. For example, 10,000 shares at $10 par becomes 20,000 shares at $5 par in a 2 for 1 split. The total par value, $100 case, stays the same.
And the accounting entry.
There isn't one. Because no dollar amounts actually change within the equity accounts, a stock split is just recorded with a memorandum entry in the accounting records. No debit or credit.
No change in total equity, no change in total par, just more shares with lower par each.
Got it.
And reverse splits just do the opposite.
Exactly. Fewer shares, higher par value proportionally. Again, just a memo entry. And splits usually don't apply to treasury stock either.
Okay, we've covered a lot of individual pieces. How do we see the whole story of equity changes over a year put together?
That's the job of the Statement of Changes in Shareholders' Equity. It's the narrative, the reconciliation. It shows the beginning balance for each equity component. Common stock, APIC, retained earnings, AOCI, treasury stock, details all the changes during the period, net income, dividends, stock issuance, AOCI changes, treasury stock transactions, and arrives at the ending balances for each component and for total equity.
Can we quickly look at that Sydney Technologies example again to see it in action?
Sure. Sydney Tech starts year one with, say, $8.05 in retained earnings, $1.05 in AOCI, $20 in common stock, totaling $30 of equity. During the year, net income, $1 CM, increases RA and total equity. Other comprehensive income, $200, increases AOCI and total equity. Issuing new common stock, $1, increases common stock and total equity. Declaring dividends, $700, decreases RE and total equity. The statement clearly lays out these additions and subtractions column by column, reconciling the beginning balances to the ending balances. $9 RE, $1.07 AOCI, $21 common, $31.07 total equity. It connects all the dots.
That statement really is the full story then. It connects the balance sheet from one year to the next via the income statement and other equity changes. Critical piece of the puzzle.
Absolutely critical for understanding the dynamics.
Okay, let's shift to our final major section, handling changes and corrections. Sometimes estimates change, or principles change, or oops, errors happen. How does accounting deal with these? Let's start with changes in accounting estimate.
Right. A change in estimate happens when you realize a previous estimate wasn't quite right. Importantly, it's not considered an error. It was the best guess at the time, but now you have better information.
Like estimating how long a machine will last and later realizing it'll last longer or shorter.
Exactly. Changes in useful lives or salvage values of assets are classic examples. Others include adjusting warranty reserves, bad debt allowances, inventory obsolescence reserves, or settling litigation for a different amount than accrued. Even some changes in principle that are tied to estimates fall here.
You use the analogy, it's like adjusting your GPS mid-trip. You don't redrive the first part, you just adjust going forward. Is that how the accounting works?
Perfect analogy. Changes in estimate are handled prospectively, meaning you apply the new estimate to the current period and all future periods. You do not go back and restate prior year's financial statements. You don't adjust beginning retained earnings. The past is the past. The new estimate affects today and tomorrow.
So in that Carlin Company truck example,
Yeah.
they used it for 2 years thinking it would last 10, then realized it would only last 5 total.
Right. Original depreciation was 90 KLD $10. After 2 years, book value is 72 KLers. Now they realize only 3 years remain, 5 total, 2 already passed. So for years 3, 4, and 5, the depreciation becomes 72K. 3 years equals 24K per year. The first 2 years' $9K expense isn't touched. Only the current and future depreciation changes.
Okay, prospective application. Makes sense. What about changes in accounting principle, like switching from FIFO to weighted average inventory? That sounds bigger.
It is a bigger deal. This is changing from one acceptable GAAP method to another acceptable GAAP method, and you can't just do it on a whim. You need justification. Either a new accounting standard requires the change, or you have to demonstrate that the new method is preferable, meaning it provides a fairer, more accurate picture of the company's finances.
Preferability. Okay. And how are these changes handled? Prospectively, like estimates.
Generally, no. The general rule for changes in accounting principle is retrospective application.
Retrospective. Sounds like going back in time.
Pretty much. It means you adjust the financial statements as if the new principle had always been used. This involves calculating the cumulative effect of the change on all prior periods. That's the total difference, net of tax, that would have impacted retained earnings if the new method was used from the start. This cumulative effect is then reported as an adjustment to the beginning retained earnings of the earliest year shown in the financial statement.
So it directly changes the starting point for equity in the comparative statements.
Exactly. And furthermore, all the prior year financial statements presented alongside the current year must be restated to reflect the new principle. This ensures comparability across all the years shown.
Wow, okay. So that Harbor Company example, switching from FIFO to weighted average, the $140,000 net of tax cumulative effect would adjust beginning RE, and the prior year's income statements and balance sheets shown would be rewritten using weighted average numbers.
Correct on all counts. Full retrospective treatment.
Now, here's where it gets really interesting. You mentioned exceptions earlier. Why is a change in depreciation method handled differently? You said it's treated prospectively.
Yes, that's the big exception everyone remembers. A change in depreciation method, say from straight line to double declining balance, is considered both a change in principle and a change in estimate. Because it's hard to separate the effect of changing the pattern of depreciation, the principle, from changes in the estimate of useful life or salvage value, accounting rules pragmatically say, treat it like an estimate. So, changes in depreciation method are handled prospectively. Apply the new method to the current book value starting from the beginning of the current year. No restatement of prior years, no adjustment to beginning RE.
Okay, pragmatic solution to avoid tangled recalculations. Makes sense. What was the other exception? Impracticable.
Right. If it's truly impracticable to figure out the cumulative effect for retrospective application, meaning you genuinely can't reconstruct the necessary data even with reasonable effort, then you handle the change prospectively. The classic example is changing to LIFO inventory in the U.S., where recreating old inventory layers might be impossible.
Got it. What about changes in accounting entity, like when companies consolidate?
This happens when the group of companies being reported on changes. For instance, starting to issue consolidated statements instead of individual ones, or changing which subsidiaries are included. This also requires retrospective application. If you present comparative statements, you restate all the prior years shown to reflect the new entity structure as if it had always existed that way. Full comparability is the goal.
Okay, retrospective for entity changes too. Finally, error correction. or prior period adjustment. This isn't a change, it's fixing a flat-out mistake. Right?
Exactly. Mathematical mistakes, applying GAAP incorrectly, overlooking facts, using a non-GAAP method when you should use GAAP. These are errors, not accounting changes. And because it was always wrong, you fix it by making the financial statements appear as if the error never happened.
So how is that reported? Does it depend on when the error occurred?
Yes. If you're presenting comparative financial statements and the year the error occurred is one of those years shown, you simply go back and correct the numbers in that prior year statement, restate it directly. If the error year is not being presented, then you adjust the beginning retained earnings of the earliest year that is presented, net of tax, just like the cumulative effect of a principal change, but because it's fixing an error.
And if no comparative statements are shown at all?
Then you adjust the opening balance of retained earnings for the current year, net of tax.
So that Jordan Manufacturing example.
Hmm.
The $4.05 depreciation error from years 1-2, discovered in year 4. If they only show year 4 statements, the net of tax impact, $2.07, reduces beginning RE in year 4.
Precisely. And their change from LIFO to FIFO, also in year 4, with a $3 and a net of tax cumulative effect, would also adjust beginning RE in year 4. Both hit the same starting line, but one's fixing a past mistake, the other is adopting a new method retrospectively.
Got it. The statement of retained earnings then clearly shows these adjustments to reconcile the beginning balance.
Absolutely. It preserves the historical accuracy.
Okay, we have covered an immense amount of ground. So, what does this all mean for you, our listener? Why should someone care about all these sometimes very technical details of stockholders' equity?
Well, knowledge is power, right? Especially in finance. For investors, understanding equity isn't just academic. It helps you truly evaluate a company's financial foundation. How do they raise money? Are they profitable in keeping those profits? How do they treat owners, paying dividends, buying back stock? It helps you see the real value building up for shareholders beyond just the stock price noise.
And for people working in business, not just accountants.
Oh, absolutely crucial. If you're in management, marketing, operations, understanding the equity section helps you read financial statements intelligently, make better decisions, and talk credibly about your company's performance and health. It's the language of business.
Yeah, being able to speak that language is key.
And even if you're just curious, understanding these concepts gives you real insight into how corporations work financially. Recognizing the nuances like why treasury stock accounting works the way it does, or what different dividend type signal tells you so much about management strategy and financial position. It's not just memorizing terms, it's reading the story the numbers tell.
Seeing the story behind the numbers. I like that. Well, we have definitely unpacked a truly dense topic today. We went from the basic definition of stockholders' equity through all its components, how it changes, how distributions work, and even how companies handle major accounting changes and fix errors. Hopefully after this deep dive, you're feeling much more informed, maybe more confident when you look at that crucial owner's claims section on a balance sheet.
Hopefully less like you need that decoder ring.
Exactly. So as you go forward thinking about financial reporting and its power, here's something to chew on. How might a company's choice of accounting method, maybe for inventory or revenue, or even how they account for treasury stock, how might that choice subtly shape how investors perceive the company, even if the underlying economics haven't really changed? What story is really being told behind those numbers? And maybe more importantly, what assumptions are you making when you read them? Something to think about.